Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. Hope everyone's doing well. We got some data this morning in terms of probably three of the most important data points we'll get this week. Usually the week after non-farm payroll is pretty quiet. This week we have some PPI data. We have CPI data tomorrow, which I would consider to be the most important data release. The second most important data release is going to be retail sales in terms of the way in which we will look at the health of the consumer. After inflation, the most important metric is employment, but kind of dovetailing with employment is, does the consumer have a job and are they spending the money that they're making? And that's where things like retail sales, home sales, start becoming really important metrics to watch in terms of what the Federal Reserve will be thinking about the next time they're all together in the hallowed halls of the Federal Reserve and determining what and when the next quarter point rate cut is going to come. We're going to likely get one more sometime between now and likely summer. One more is in the cards. Two is very unlikely, but it's not a no. It's just the lesser of the two probabilities. The chance that we'll get no rate cut certainly is something we can think about, but we always want to put a hierarchy of probable to least probable together. And the most probable, the thing at the top of the list that the data shows is most likely is 1 quarter point rate cut. The next most probable thing is a hold, and then the after the quarter point cut, and then 2 quarter point cuts is a little bit of a pipe dream, but it's in the data, just not in a more meaningful way. What does that mean? Why do we care? Because at the end of the day, whether or not the Federal Reserve is going to cut or not is going to be a big part of why equities might rally. Remember, it's the getting, not the having, that the market tends to respond to, or as it's often called, buy the rumor, sell the news. Think about how much less the rally after September was as opposed to the rally of the first 9 months. Think about 0 to 9, January to September, we get a half-point rate cut. And then the rest of the climb became far more arduous and less. Now that December 18 has come and gone, and that was the last meeting of the Federal Reserve, Jerome has most definitely taken the wind out of the sails. And that's where we are now. You know, he's pretty much communicated that they're done the bulk of the cutting. So it's no surprise that volatility event on the 18th, where Jerome said, yeah, we're pretty much done. It was a shock. You don't end up with a 2.5-inch candle on your screen because everyone expected it, right? It was a surprise. And then we're trying to find our footing in a post the FOMC is likely no longer really dovish environment. That's just the way this game is played. The only macro that matters, all right, is what Jerome sees, watches, thinks, right? And then ultimately says. And the Fed chair is the only one who's empowered to speak on behalf of the FOMC. Everyone else has an opinion. His is the only one that matters. And at the end of the day, we're stuck in a bearish chop. That's the end result. All right, Rob, what's the punchline? We're in bearish chop. All right. Why does all that matter? There's a couple trends we need to be aware of. The first trend is the macroeconomic trend, and that's what we've been talking about for the last 4 minutes there. Macroeconomic trend shifted abruptly on the 18th of December. Then we're thinking about, when I say we, I mean traders, investors. Well, what does that actually mean to the equity markets? They too have lost their trend. They're now in chop as well. That means our tactic as traders and investors, what I have to do is I have to change my strategy to something that acknowledges that we're no longer in a trend. We're not in a downtrend. Please don't think binary that if we're not in an uptrend, clearly we must be in a downtrend. That's just not accurate, and nor is that really helpful. In between those shifts in the trend is chop. Sometimes it's bearish chop, sometimes it's bullish chop, but nonetheless, it's chop. Chop is tough, especially for traders who want to continue to treat the broader averages or whatever symbol that might be as a trend. It's not. And chop is really tough, if not downright brutal, for momentum traders, because this is where every surge higher looks like it might be continuation, which works in a trend, but it's likely just going to gut your account in chop. So chop is tough for everybody, most especially momentum traders. And chop is something that's tradable, but there's a couple things that are going to happen pretty naturally. One, you're going to have far fewer things to trade. The watch list will be shorter, therefore the setups will be fewer, and ultimately the entries will be fewer. If you find yourself pushing along at the same pace now that you were in November, I'll tell you this, for me, I'm far less active right now. You have a couple positions, but throughout October, throughout September, October, November, it was nothing to have 6 to 8 open swings open, swing trade positions, overnight positions open. Now I'm either 0, 1, 2. That's logical. That's tactical. That makes sense for the environment that we're in. So number one, look at your pace of trades. One of the easiest ways for traders who are struggling, whenever I do talk to some in person, I'll always say, do this one thing, right? Just one thing, not 19 different changes, not revamping the trading style, not adopting mine. It's first thing, whatever number of trades you're putting on right now, presuming it's not 0, cut it in half. What? Yep, just cut it in half. Because what that's going to force you to do is say, look, if I'm typically trading 6 or 8, now I'm 3 or 4. It's going to force you to be more discerning. It's going to force you to find the very best of what you see. And it's going to very naturally limit the number of entries you've got. So in chop, just if trading it and finding the tactics and your footing and stuff, do the easiest thing in the world, cut your trading, the number of trades in half. Cut your watch list in half. In other words, force the very best stuff to the top. All right. So ultimately, what we want to keep in mind is, let's go to the calendar here. All right. So let's take a peek at what we've got here this Tuesday morning. All right. Core PPI came out. There we go. And PPI is not the same as CPI. I really don't look at PPI as a major number. Again, in terms of ranking this week's hot zones, scheduled high impact events, CPI is first, retail sales would be second, core PPI and PPI would be really a distant third. And yeah, this is really more in the inflation bucket. It's the change in price of finished goods and services, right? So it's a change in price. And if it's relatively flat, right? If it's relatively flat, not really telling us much. In this case, it's down 0.2 on core. It's down 0.2 on the non-core. Core just means they're usually excluding something, right? So if you have a regular release, whatever it might be, PPI, whatever, and then you CPI, PCE, and there's a core version, core usually excludes something. It could be food and energy, because heck, who needs that, right? But welcome to the ridiculousness of data. So there's your release, and that's what we got. Slightly lower, which is lower better. Yeah, if you're in an environment where you're concerned about things continuing to increase in price, this would be considered better. Let's see what the response was like. All right, so let's move on over here. And, please do take the context of where we were before the data into consideration. What was the range all morning long? We're pretty much stuck in the range. All right, so if you take a look at where we are now, there's your initial candle, and give it a beat, right? That's a 5-minute candle, by the way. Give it a beat. What's happened in the last 20 minutes, 30 minutes? It's just sucked right back up into the range. We haven't gone anywhere. Even that large candle up just spanned the range of where we were. So here's another really easy question to ask yourself when you're trying to gauge, what did that data mean? Did we go anywhere new? New high, new low, and follow through? Or do we spike one way, spike the other, and ultimately end up nowhere? That's the latter. So this is just a big cup of nothing. When we look at the response to this, there was a bunch of reaction. And then as soon as the dust settled, we were right back where we were. So is this good? Nope. Is this bad? Nope. There's nothing in this that's particularly shocking. particularly shocking. Is it good news? I would say it's not bad news. At least inflation's a little bit cooler. But again, without looking at the calendar as a whole, it would be easy to say, well, how come this isn't being responded to in a way that's more positive? Because if inflation's in check, that means the Fed can maybe keep cutting rates. Yeah, but let's remember that CPI is tomorrow, and that matters a whole lot more. So everything requires context, gang. Everything requires, hey, this came out, but then we know we have CPI tomorrow. Let's not get ahead of ourselves, right? We have CPI tomorrow, right? Yeah, there it is. We have CPI tomorrow. So does the UK. There it is. So there we have CPI. So let's not get ahead of ourselves because there is a much more meaningful and direct inflation gauge tomorrow. So I really don't look at PPI as much of a big deal. And you can see it really wasn't a big deal at all. All right. So measuring things in the right way makes a really big difference. Knowing when to measure, knowing what to measure, and looking at the context that preceded the data is, as you can see, really important. Because if I looked at it like this, right, it's a very, look at that move, right? But if we look at it like this, we go, oh, we've been all over these, and we've been all over that very well-worn path. Did we go anywhere new, right? So hopefully that helps. Okay, next up is, where are we in that post-hot zone environment? Look, gang, there are two downtrends in the indices right now, and it's not the S&P and it's not the NASDAQ. Knowing where you want to be bearish means we build a watch list of symbols that have the highest probability of either moving higher or the highest probability of likely moving lower. And the same symbol cannot be on the same watch list. So if you're struggling with what to trade in the direction to trade it in, make one bullish watch list, make one bearish watch list. And again, if you see the same symbol or some sort of overlap there, for example, I'm bearish industrials. There's no way I'm going to be bearish industrials and have the Dow on my bullish list, right? That would be conflict. That would be where there's just not lining up. The index, the Dow, is the top of the food chain, and the industrials would be within that, under the umbrella of the Dow. So I really don't want to see a situation where I've got the index on a bullish list and I've got one of the major sectors on a bearish list, or vice versa. In this case, XLI is weak, and so is the Dow, and I would look for the trend to resume. It's going to be tricky, gang. I don't like trading downtrends. I really don't. I'm optimistic by nature. I think that for the most part, if you look at a logarithmic chart of the equity markets over the past 50 years, 100 years, if you look at the equity markets of the United States, they go up. There is a path of least resistance. And it is indeed a path of least resistance, right? The general gist of everything is up. Central banks support this. Monetary policy around the globe supports this. Periods of bearishness, while violent and oftentimes abrupt and certainly scary and uncertain, are very short-lived, right? So would I rather trade the environment that happens most of the time, or would I rather trade the environment that gets a lot of attention but happens far less amount of time? Well, I think that I'd rather be bullish, and I'd rather have an environment that I'm going to deal with most of the time. It doesn't mean that we're not going to deal with bearish environments from time to time. And just because a Dow is bearish doesn't mean the NASDAQ is. So keep in mind, if you're looking for weakness right now, if you are a bear, we still have to be discerning. Never paint the entire marketplace with one brush. Right now, bearish brush all over the Russell, all over the Dow. We know financials are heavy. We know regional banks are heavy. We know that healthcare has been right, past tense, but it's been really heavy. But now it looks like financials are heavier. It looks like industrials are heavier. It looks like transports aren't too heavy. It looks like energy has been waking up. So there are some things that are waking up. Maybe early, but keep an eye on energy. Maybe early, but maybe keep an eye on healthcare. A lot of that energy strength is coming from crude oil. So some things are waking up, and these things were pretty heavy most of last year. And some things are just rolling over, like the Dow, the Russell, the S&P is trying to roll over too. So we trade what we have at the right side of the chart. The hard right edge is where we live. Traders who tend to struggle look at the past and they lament right? This is like looking back at high school and thinking about glory days. That ain't where we are now. And I think a lot of traders kind of look back and go, oh, but NVIDIA used to be doing this. And oh, but Tesla used to be doing this. I could do that with Amazon. Amazon was a monster trade for us in Q4. It's not the same quality trend. It's not bad. It's actually one of the better magnificents, but it's not what it was. So we live on the right edge of that chart. Be careful looking at what was so good and presuming it still will be, right? Tesla had a great run shortly after the election. It's a very different right edge of the chart now. And now that right edge is really, really curtailing a lot of the length, the amount of things that I would have considered trading even, 45 days ago. Don't paint the market with the brush that we got to paint it with in November. December, after the 18th, has been really telling. The macroeconomic trend has shifted. All right. Okay. So let's see what else we've got here. Any questions or symbols for me? We've got about 3 minutes. So if you do have a question, feel free to type it in. One of the other things that I've been getting questions about are bond yields. Gang, I wish we could just put this thing to rest. I mean, the notion that inverted yield curves are helpful is something that is absolutely incorrect. I'll go so far as to say now, if folks talk about inverted yield curves, they just want to look smart. They really aren't. Here's why. Inverted yield curves have been happening for almost 3 years now. Pretty sure we punched up to numerous all-time highs throughout 2024. It's about the dumbest thing anyone could focus on. So let's take that off the table. But Rag, what do bonds tell us? Let's talk about what's real and useful. Okay. Number one, bonds are never here. Right now, it's the 14th of January. The bonds at best are thinking about essentially April. They're always at least a quarter ahead. So when we were seeing the weakness in bonds in October was talking about, oh, hey, January. And they were right, but they weren't right about the now. After bonds went into a downtrend in early October, the equity markets, the NASDAQ, the S&P were still punching up to higher highs because the bond markets were not making commentary about now. They were making commentary about 90 days at minimum from now. Inverted yield curves mean nothing. What the 10-year and the 3-year are doing and interacting mean nothing. Again, I turned on the television yesterday and someone's yammering on about the 10-year. Here's what you need to know. This is how it works. And if you think about it, it makes perfect sense. We're always seeking a return. So at some point, if bond yields continue to increase, right? Some of you might look at the ZN, the TNX, here's a ZB. So if you're looking at futures and they're moving lower, that means the yield's moving higher. I know, it's just an inverse thing. Okay. At some point, that higher yield from a note, from the long bond, is in competition with the expected return of the stock market. That's it. But can you imagine, to simplify that on television, what are they going to talk about? How are they going to confuse you? How are they going to look smart if they don't make this ridiculously complex and esoteric? The bottom line is the market's always in competition for our money. And wherever it looks the most tempting is where our money goes. If we're concerned about the future, we're going to go to somewhere where we can get a return with a seatbelt, right? And we want a little bit of safety and protection. If the equity markets are rallying and the Federal Reserve is cutting rates, we're reckless. We're taking the helmet off. We're not wearing a seatbelt, and we're just buying whatever. So some of that context matters. But right now, when you look at the uncertainty of monetary policy, the uncertainty of the year, and then you look at a higher yield, all of a sudden that higher yield compared to what could be expected from equities, from buying stocks, all of a sudden they're in competition. There's an arm wrestle going on, and sometimes those yields are going to win. Same thing with dividend yielding stocks, right? That's why staples sometimes outperform, say, tech, or utilities sometimes outperform other, types of more sort of alpha-oriented equities, because people are looking at it saying, well, do I want to be more aggressive or not? And where is the return? That's it, period. Anything more than that is just meant to try to impress you. And it's really not impressive because it's so consistently wrong. Okay. So ask yourself, what's in competition for my money and my attention? Is the flow going there? And ultimately, is there a trend? Right now, we're lacking trends. Lacking trends means there's a lot of uncertainty. It makes sense to tap the brakes. That's where we are right now, gang. So hopefully that gives you a little bit of insight in how to manage a lot of just the terrible advice and content you're going to see out there, especially around yields. That's how you want to look at it. Are yields in competition with equities? If so, yields can sometimes win. All right, gang. Be good to each other. I'll talk with you soon.